Did the real estate market crash last year, or are we in the beginning stages of a real estate market crash right now? David Stevens, who is the former Assistant Secretary of Housing, recently said, "This may be the one and only window for the next few years to get into a buyer's market." And remember, as the Federal Reserve data shows, some prices only go up and always recover from recessions, no matter how mild or severe. Long-term homeowners should view this market right now as a unique buying opportunity. This article compares today's market to the one we had in 2008 when we had a major crash, and says today's market is nothing like it. Why is that? Well, today there are currently 20 million more jobs than there was in 2008. But there were 3 million less homes built in the last few years than there were in 2008, and 3 million less homes on the market. Additionally, back in 2008, the lending practices were pretty irresponsible, and subprime loans were common, whereas today they're pretty rare. And because of the frivolous lending practices we saw in 2008, the foreclosures went through the roof. Here's an example of the current level of foreclosures in the Phoenix metro area compared to that of 2008. But prices have gone down and less homes are being sold today compared to a year ago. So what caused this change? Well, at the beginning of last year, the interest rates started to rise, and starting in April, those rate increases got aggressive. We started last year in the mid-threes and ended the year with an interest rate of nearly 7% by the end of December. And you can see at the beginning of this year, when the interest rates started falling again, the median sales price hit a plateau and stopped declining. And you can see in this chart that the listing success rate hit healthy levels in February when the interest rates started falling. Next, I'm going to show you the Cromford Market Index chart, which measures supply and demand in the Metro Phoenix area. A Cromford Market Index, or CMI, in the range of 90 to 110 is a balanced or neutral market. Anything below 90 is a buyer's market, and anything above 110 is a seller's market. You can see just how fast the market reacted to those interest rate hikes starting in April of last year. You can also see that the CMI has been steadily increasing since the start of this year. And now at the end of February, we have a CMI of 153, which is technically a seller's market. All of this to say that the interest rate hikes are the driving force to the changes we're seeing in the market today. If and when the interest rates start falling again, we are probably going to see prices start rising as the competitive market we've seen over the past few years starts to return. Of course, there are all sorts of variables in the real estate market, and there could be some unexpected event that comes and changes things, but this is my take on it. But I want to know your take. Do you think we've already seen a crash, or that we have yet to see a crash that's coming?